Hi, everyone. This is Jason Bjark of Wall Street for Main Street.
And Lee Justo from Risk.
And this is episode number 8 of Finance Unspun. We're recording this episode on Thursday night, August 25th, 2022. Lee, just craziness continuing to go on, all these current events and news stories. The dollar is rallying, but all these events that are happening in the oil market, just absolutely nuts from some of the comments and news stories that we've seen lately.
I think the big thing is OPEC and their threatening cuts of production, which will dry up the supply, drive the price higher. It's just crazy, Jason.
Well, for our listeners out there, the oil price is down substantially in the last 2 or so months. But if you talk to oil fund managers, talk to hedge fund people, it's not based on fundamentals and supply and demand. The Saudi oil minister had some very interesting comments this week. I was actually shocked to see what he said publicly.
I'm not shocked at all. The ironic thing is that OPEC's whole deal is to manipulate the price of oil. That's what they were founded for. So it's kind of hypocritical, but it's market manipulation is certainly out there. People have been convicted of market manipulation in the oil markets as well as in silver. What's interesting though with the oil markets, it's been more like small time guys, but with silver, it was actually JP Morgan, two guys there. So it happens. You got to wonder if there are some big fish manipulating the oil market now as well.
I suspect, Lee, that the Biden administration ordered or at least made a deal with some Wall Street firms, maybe some investment banks, maybe some hedge funds, in order to help them manipulate the paper price for oil. As we've been talking about for the last, 6 weeks, there's been a lot of weird things going on in the oil market, especially the U.S. oil's futures contracts. So for listeners out there, and we're going to get comments here that, they're not manipulating all the oil prices. Well, it's almost all, and the Saudi oil minister said, U.S.-based oil's futures contracts with the manipulation. There's spoofing going on. There's a lot of increase in oil's futures contracts, and the paper price smashes in oil's futures contracts. Lee, it sounds almost the exact same thing when I'm speaking to oil fund managers, what they're saying, what the Saudi oil minister said, almost the exact same thing as what people in the gold and silver community have been saying has been going on for decades now.
Oh, no doubt about it, Jason. My time on Wall Street Silver, we talked about the price manipulation constantly, and so many of our guests were so tuned into it. So, and then we actually have convictions showing that it actually happened. It wasn't like made up conspiracy theory stuff. So it would not surprise me at all if it was happening in the oil markets, or for that matter, any of the commodity markets. Years ago, they would trade on the floor in pits, and like all the traders knew each other, and it was, unless they were colluding with each other, you couldn't really get away with these kind of things. But now that everything's electronic and remote, doors open, I guess.
And Lee, I want to add some points about how tight the oil market is. So there's not a lot of new oil supply coming online. The Saudis, I think, said they might increase by about 1 million barrels per day by 2025, 2026, but most oil experts don't think they actually will increase. OPEC has been talking for months. Josh Young, the oil hedge fund manager, he was predicting this a while ago, over 6 months ago, that OPEC had no spare capacity. Now, some OPEC producers have said that they will eventually increase production a little bit, but a lot of people don't believe that they will be able to without enormous amounts of investment. And a lot of that investment is actually not going into oil production. Now, we've seen some natural gas here in the U.S.
They're doing share buybacks again, aren't they?
Well, they have free cash flow. So I may put out an article for patrons in the next week or two. The oil industry, especially companies that have a good natural gas mix here in the U.S., they are flush with cash flow. Big cash flow increases, especially free cash flow. If you have a good amount of natural gas, if you're a liquefied natural gas exporter, you have an enormous amount of free cash flow. And what you're seeing these companies do, they're not spending as much necessarily on drilling or riskier projects that might take 5, 10, 20 years, deep water offshore stuff. You're seeing more, like you said, dividend increases. You're seeing these companies like EOG Resources, Diamondback, Devon Energy, some of the other US based oil and natural gas producers with close to a 50-50 mix of oil and natural gas announced kind of an adjustable dividend policy where, depending upon their cash flow and free cash flow, they will pay out 20 to 30% of free cash flow in dividends, and then also the share buybacks. But if the oil price manipulation is going to continue, you're going to see these firms do more mergers and acquisitions. The supply market is tight, though. I think I mentioned this a little bit on my Chris McIntosh interview. I've never seen this before, by the way, where the Iranian crude oil was actually selling at a $10 per barrel premium to the futures contract. I've never seen that before in the oil market.
Once again, that mimics the precious metals market where you're actually buying physical and the premiums are so ridiculously high. So the real price that you're paying when you buy something is much higher than the spot price.
Exactly. I've never seen that before in the oil market. I mean, we've had just in the last 2.5 years, we've had two things now that I've never seen before in the oil market. And for our listeners who are not familiar, my day job was actually as an oil analyst covering oil and natural gas stocks, pipeline companies, as an investment analyst years ago for a paid newsletter writing company that was at one point the size of Agora Financial. And I worked with Robert Rapier, who has over 30 years experience working in the oil and natural gas industry and one of the top oil and natural gas investment newsletters. So we have...
For our listeners who are more into the precious metals market, but are interested in the oil market investing, what's your view as far as looking at it and analyzing oil companies versus mining companies?
You can bring, unless it's a deep water offshore well, you can bring on oil and natural gas production. Most wells here in the U.S., as long as it's onshore and there's pipeline infrastructure and there's oil service companies like Schlumberger or Halliburton, some of the larger ones are there and there's pipelines around, you can bring oil production, oil and natural gas wells online far faster. It is a way more efficient process, Lee, than restarting a mine or bringing a new mine online.
Okay. No, I mean, that's a good insight.
However, there are...
To play off this theme of rising oil prices and, tightening supply in the future, and it looks like the price of oil is about to start making a climb back after its pulled back over the past couple months. How do you foresee investing in the future? Are you looking to invest in oil companies? Are you looking to invest in something like a Schlumberger or Halliburton oil service companies?
It's actually funny you just brought up Schlumberger, because I was actually just looking at their financials a couple hours ago from the Q2. They actually had negative free cash flow in the second quarter. So they're raising their prices for drilling. Their costs are going up. They are getting more business to drill. However, they're not flush with a lot of cash. So the businesses that are actually, the oil industry in general is getting a lot of business, is getting a lot of free cash flow. So it's the oil and natural gas producers and the pipeline companies and the refiners right now that are flush with free cash flow. So the drillers right now are not...
Do you foresee with that free cash flow that these companies are going to start utilizing companies like Schlumberger as they develop new wells or come back online?
They are...
With all the free cash flow and potentially higher demand?
Yes. Now, the capital allocation for a lot of the larger oil and natural gas companies, as we discussed earlier, they're preferring right now to do dividend increases, share buybacks. I'm 100% sure they're looking at mergers and acquisitions now because of the discount to buy discounted oil and natural gas reserves relative to the spot prices and the valuations on the reserves. So these larger companies, larger and medium-sized companies, are going to be very aggressive in the next 6 to 12 months. But the oil industry, this oil industry, oil and natural gas industry, the producers are very, very flush with cash right now. So they have a lot of good options. So unlike the past, I'll give an example, a company like Petrobras. So Petrobras right now, they're paying out the most dividends of any of the larger oil companies. I think their price to earnings ratio is below 3. They are paying out a dividend yield above 20%, and they have a lot of free cash flow from oil and natural gas. The biggest risk, though, for a company like Petrobras is not with their costs, is not with the underlying business. They've paid off an enormous amount of their debt already. I think they went from over 70 billion in net debt 3 or 4 years ago. It's down to under 18 billion now. The biggest risk for the business at Petrobras is politicians and bureaucrats, windfall profits tax in a country like Brazil where the where the minimum wage is so low. I think around 25% of their annual, around 25% of the monthly minimum wage for the workers in Brazil is spent for gasoline and diesel. We could see politicians try to force Petrobras to subsidize some of those gasoline and diesel prices for the Brazilian consumer. Instead of getting market price, they have to then offer subsidies. So that would hurt their that would hurt their cash flows, free cash flow and bottom line then.
You know, there's an interesting side story here, and that is the cost of living increase and how it's impacting the supply chain. I don't know if you know, but there's a strike going on at Felixstowe in the UK. And that port is actually a flow-through port to the United States. So goods will come from Europe, flow into Felixstowe, and then flow out of Felixstowe. They'll transfer to like different boats or ships, I should say, and then they come to the States. So that could, in the near future, cause even more supply chain woes than what we've been facing now. And that kind of begs the question, with all the supply chain woes, the cost of living going up, is it going to create demand destruction for crude oil? And then we also have to throw in the mix the Inflation Reduction Act, which is promoting all kinds of green energy stuff.
So in other countries for the winter, I think because the natural gas price is way, way higher, or it's not available in emerging markets or Asia, because liquefied natural gas shipments have been diverted from emerging markets in Asia. They've been diverted to the UK and the European Union instead. Or you have countries like Australia that have banned a large portion of their, or was it all, of their liquefied natural gas exports. So some of these countries are actually planning on using oil as heating oil or burning oil for the winter. I mean, the Saudis are buying discounted Russian crude. So I don't think there's going to be long-term demand destruction for oil. I think the carbon stuff is smoke and mirrors. I think like the majority of the oil demand growth, Lee, for gasoline and diesel, it's coming from China. It's coming from India. It's coming from emerging markets. It's not coming from developed countries like Japan, the United States, the United Kingdom, the European Union, Canada, Australia. So the growth projections are still increasing long-term for those emerging market countries because they want electricity. They want to drive a scooter. They don't want to walk. They don't want to take a bicycle. So they're becoming more efficient with their transportation long-term. I don't think these trends are necessarily going away, regardless of what the Paris Climate Accords or the Davos crowd. Because let's be honest, the people in China, the Chinese government, do they listen to the Paris Climate Accords? Do they actually listen? I mean, they're the main manufacturer.
They're pretty much exempt from everything.
Exactly.
But they're imposing it here, you know, in the West, and it's being imposed in Europe and the United States equally. Well, as we can see from the Inflation Reduction Act, and then this whole thing with the nitrogen in Canada and the Dutch farmers. I mean, it's but
my point though is that we've only, I think, had really wide-scale demand destruction and collapse of oil and gasoline demand and jet fuel demand for, I think, 2 or 3 years out of the last 15 or 20. It's a very small amount, and it was only for a very short period of time. I think it was 2008 and 2020. And look, in 2020, they had to shut down everything. And then within
they didn't have to, they did.
Well, they had to shut down everything to kill gasoline demand. That was my point.
Oh, I see what you're saying.
Yeah. So I'm not in favor of the lockdowns. I'm saying they had to, in order to destroy oil demand, gasoline demand, jet fuel demand, they literally had to shut down everything.
You know, I saw an interesting video today on YouTube, and it was a gentleman, I forgot the channel, but he was out in California, and he was saying how boats are now going for like 50% of what they were just a year or two ago.
Well, you got to add fuel costs, right? If you're going to if you're going to put the diesel in a large fishing boat or a yacht, you're looking at way above $5,000. It's like over $10,000 now.
Yeah, could you imagine? So
yeah, sugar babies are cheaper. I'm
assuming
for those rich guys.
that sales of sailboats is going to rise, and people are going to switch more to sailing than they are powerboating. It'd be interesting to see that. And I was also, that kind of led me down the road of, okay, what about bicycles? I can imagine people, you know, especially in the bigger cities, starting to ride bicycles more and taking taxi, because I'm assuming that the price of Uber rides and everything else is going to be going up.
The price of a lot of things, Lee, is going to keep going up. I mean, the supply chain problems, they haven't been fixed. In many cases, are actually getting worse. Now, you brought up the oil service companies. A couple more points here before we close out on oil, unless you have any other points you want to add.
Go ahead, please.
Okay, so Schlumberger, they were talking about, and they're not making free cash flow yet. I mean, they are getting more work. They're going to be raising prices. Their costs are going up. They're going to have to bring new labor back from construction, home construction. They're going to have to offer higher salaries. So their costs are going up. They're going to be raising prices, and they're going to start generating free cash flow in the coming quarters because they're not going to want to continue running at a loss. I think they just still paid out a dividend, but they want to generate free cash flow because that's how the economy really works. It relies on if you have a business, unless you're a Silicon Valley unicorn and you're fooling shareholders and you're going to dump the IPO onto retail investors at the end, you have to generate cash flow. You have to generate free cash flow. You have to look at your profit margins. So Schlumberger is going to focus on free cash flow, improving profit margins. They're going to be raising prices. Their costs are still going up. I was looking at Diamondback Energy, which is a fairly large mid-tier oil and natural gas producer, I think in the Permian and other parts of the U.S., a shale driller. And they said in their Q2 earnings about 3 weeks ago, their costs year over year up 15%. So 15% year over year cost increase for oil and natural gas drilling costs for wells. Lee, like 4 years, a little over 4 years, their costs are going to double.
Yeah, which will send everything else up as well.
Yeah, but we have deflationistas saying demand is going to collapse. The commodities bull market's over. Meanwhile, here in reality, if you talk to the oil companies and the producers, all they just keep saying is their costs are going up. The supply market is tight. So I think things are going to reverse. I mean, if costs keep going up and the paper price, the oil futures contract keeps getting smashed, I think OPEC will cut the production. And then I think you're going to see more of an equilibrium there.
Gotcha. It's certainly going to be an interesting to watch how it unfolds over the next few months.
Well, as I mentioned, I don't know if you listened to the Chris McIntosh interview yet. I think the new normal now, because of government, central banks like rules changes, intervention, tax policy, we're going to have a lot shorter cycles with a lot more volatility because of all these rules changes and tax law changes. And I know people listening to this don't want to hear that. They want an easier solution to their retirement account, their investing. But unfortunately, that's the new normal. We're going to have a lot more volatility, a lot shorter cycles. We could have a swing, Lee, where the oil price, maybe in the short term, it goes down a little bit more, but then 6-12 months from now, we're right back to $120, $130, $140.
Oh, I think that's without question going to happen.
That type of whipsaw, though, is not good for retail investors. It's good for hedge fund managers that have
it's great for traders. Yeah, great for traders and hedge funds. No doubt about that. Volatility is king for that. But for investors, it'll shake a lot of people out and make people nervous. And people always tend to sell at the top buy at the top and sell at the bottom.
Exactly. And there's also a lot of people listening to this podcast too. I speak with them. There's a lot of retail investor day traders that are using margin, and they're not hedged. They don't have volatility trades on. They don't have any long straddles. They don't have any, if they're short, they don't have any upside protection. If they're long, they don't have any downside or put protection. These types of market swings with volatility and shorter term cycles.
Oh, could you imagine being short oil and it just ripping on you like,
yeah. If you're short oil Lee, if you're short oil and the Saudis announce a production cut, you're going to get screwed bad.
Oh boy. This whole, I was looking up, oil pretty heavily and what was going on. And then I saw that video on the boats and then I'm thinking like, okay, so how can you play higher cost in oil? And one of my thoughts was bicycles, right? But Peloton had like a $1.3 billion loss. I think the number was, I can't remember. Hold on. Let me see. I wrote it down here. Yeah. It was a $1.2 billion loss. And it's a 28% drop in revenue. But then I'm starting thinking that's due to like the subscriptions because people's lives have changed. They're not home anymore. They're out working now again.
Well, also, can you afford the extra subscription? I mean, like
exactly. Yep.
In this environment, Lee, where you have the basic necessities. So like rent, mortgage payment, food, gasoline, diesel, electricity, healthcare insurance, all the basic stuff that people need, an average middle class or working class person, small business owner needs to survive, just have a halfway decent normal life. All these costs are up a lot. The first thing that goes in people's budgets is the discretionary spending. So Netflix.
Like Netflix subscriptions
Yes.
and everything else.
Yes.
Yeah, no doubt about it. But, you maybe can still play it with a company like Shimano or Vista Outdoors. They're actually making bikes that people will use to commute and get around in. It would be interesting to look a little further into that industry.
We have one more major topic I think we wanted to talk about on the show before we wrap it up. We're going to try to keep it, I think, under 30 minutes. So the oil prices right now, we've had a little rally before we close out with oil. The WTI crude price is back above $90 a barrel. It had dipped. The market is starting to get worried about the traders who are short are starting to cover. They're worried about the Saudis and the potential OPEC and the Saudi put underneath the market, because now you have this dislocation, this discrepancy between the U.S. oil futures contract versus the tightness in the physical market that we're hearing from a lot of different sources. But the gold and silver market is what we wanted to talk about, Lee, to wrap this up. I think, and we talked about this on past shows, if the dollar index is going to continue to rally, and the dollar index right now, let me just pull it up real quick. The dollar index is at 108.52. So if the dollar index is going to continue to rally, some of these global hedge fund managers, these macro tourists, a lot of these guys are deflationistas and hate gold. So their bias is almost always negative gold. But if the dollar index rallies, they're going to continue to increase their short gold futures positions, their short gold stocks positions. Same thing for silver.
Well, the dollar right now looks like it's either going to challenge its recent top and break through and then start climbing, or it's on its way back down. It's like a 50-50 call right now looking at it. Gold and silver, I don't know. I think we bottomed. I really do, a couple weeks ago, and I think it's I think we're going to be climbing here. But it will certainly be interesting to see how it shakes out. And, of course, there's always market manipulation in that space, as we know.
And Lee, we are at levels right now with the dollar index. I would call it a global margin call. So if the dollar at these levels and higher, so the dollar index hits 110, the dollar index hits 112, 114, 115, God forbid 120, you're going to start to see potentially large investment banks, hedge funds, family offices. These guys had enormously over-leveraged currency trades, these carry trades, these leveraged bond trades. They were betting on the Fed not raising interest rates anymore. You're going to see them start to either force liquidations or bankruptcies. You're going to see lots of these Archegos or worse type scenarios.
Well, those always come when we have volatile markets, because there's always someone on the wrong side of the trade. So, what's your thought on all this ahead of Jackson Hole?
The dollar, yeah, but Lee, I would argue that the dollar and the Fed hiking rates is even worse, because go back and look at past crises, whether it was the Asian tiger crisis or the tequila crisis. I mean, the dollar rallying can literally take out entire emerging market governments like Thailand and others.
Well, it puts a tremendous financial strain on them,
especially those countries that gambled that the dollar was going to get weaker. And I've talked about this in cycles with my dollar tug of war theory. When the dollar gets weaker, you have these foreign governments, mostly emerging markets and foreign corporations. They borrow even more dollar-denominated debt, but then that creates more demand for dollars later on. So that's why the dollar, up until the last couple months, stayed in a wide trading range between, I think, like 89 and 104 on the dollar index for the last like 7.5 years or 8 years up until the last couple months. Mm-hmm. So we might have a higher trading range now in this dollar tug of war.
What are you foreseeing, like between 110 and like 100?
Well, I think the Federal Reserve Bank and I think the U.S. Treasury would like the dollar lower, but I think everything else is doing so freaking bad right now. I mean, there's, on a relative basis, Lee, there's so many problems in Japan, the European Union, emerging markets, China.
I think one of the biggest supporting factors of the dollar has been for a very long time that it's the best of the worst of the fiat currencies. And, there's certainly indications and rumblings around the world with China and Russia and Brazil. And I mean, competing currencies that they're going to develop and maybe commodity based. But I think that's a while off. And I think we're going to have some choppy waters ahead.
And Chris McIntosh and I discussed this yesterday, that Russia and India are both announced recently, that they're starting larger physical gold bullion exchanges. So similar to the Shanghai Gold Exchange in China, now you have Russia, now you have India. They want to import even more physical gold tonnage. This is going to put pressure on paper price manipulation for physical gold here in the US with gold and silver futures contracts, because the pretty much all the manipulation occurs here in the US with the futures contracts and the derivatives markets. Although a good amount does still occur in London on the LBMA, but the majority still occurs in the US.
It's interesting that Russia and China and India, they're all much more into precious metals than the United States. I mean, any economist or financial person would just look at you like you have two heads if you say that you want to invest in precious metals.
Well, Lee, did you see the new Swiss gold refining export data that just came out? Because while all the articles on gold here in the United States, the Western world, are negative, that the gold rally has ended, the dollar's going to continue to rally, gold's going to crash. The Asian buyer, especially out of China, the private sector demand, and also central banks, but the private sector demand in China has exploded. Did you see the Swiss gold refining data?
Well, I have not had a chance to review it yet, but
so KidCode just put out the story earlier this week, and I'll put a link to it below the video in the information and description section. So we are at a 5.5-year high for Swiss gold refiners exporting gold to mainland China. That's private sector demand.
I think that says a lot about the people in China and their worldview. I mean, you invest in precious metals because of the stability that it offers you. So they must be seeing things. I mean, China's just a complete mess. I mean, their real estate bubble is insane. I was actually watching a Kyle Bass interview today, and he was talking about real estate. And during a financial crisis here, I think real estate climbed to 6 times salary average. In China now, it's like 36 times salary there. So their real estate bubble is magnitudes bigger than it was during the great financial crisis here.
Yeah, the Chinese banks just don't have all the crazy derivatives attached to it, but the sheer size of the Chinese real estate market is larger. And they have all those. Have you seen the videos? All those buildings are falling apart. Those luxury condos in many major cities, they're collapsing.
Well, they're probably poorly built and they're neglected now. So, and it's what came across today was Blackstone. They're stopping purchasing real estate in I think 38 cities in the United States here, which I think that kind of says something about the real estate market here.
Yeah, or Blackstone and BlackRock are waiting for the Federal Reserve Bank after like a crash to give them more zero interest rate loans and free capital to go buy more.
Very true. And then by that time, the price will be much lower too. So.
Yeah, I mean, if they're going to change the rules and they're going to bail out the home builders, Congress is going to give the home builders tax credits like they did, I think, in 2009. So the home builders didn't all go bankrupt. I know hedge fund managers that were short the home builders, and the rules were changed so that the home builders got like tax credits on their accounting and were allowed to not have large losses or basically be insolvent. And in BlackRock.
I'm sorry, it's kind of along the same lines. Do you think this whole student loan bailout's going to drive inflation further as well?
The money supply is already enormous here in the United States. You have other countries that have run dollar pegs. And so when the US inflated the money supply, those other countries did too. It's just a mess. You add in the supply chain problems, you add in the food and energy problems. The distortions are unprecedented. They're very similar to wartime distortions that you would read about in the past with wage and price controls and shortages and rationing. It's very similar to that. With capitalism and free markets, if you speak to a business owner and ask him how they could fix him or her, how they could fix the supply chain problems, they would lay out a plan. They would say this could get fixed. We might have to pay higher costs for a while.
Pretty rapidly, Jason.
Yes, this would get fixed. We might have to charge higher prices for a while, but we could get the supply. We could fix the supply chains. Instead, you still have politicians, bureaucrats, and regulators making things worse.
Exactly. And that's the case in all industries.
And this brings us back to commodities as we wrap things up here. The gold market, again, with Asia and China. The last thing I wanted to talk about with Chinese gold demand, again, if this trend continues, if the Chinese gold buyers going to continue to buy the dip aggressively with Swiss gold exports to China at 5.5-year highs, I think the wholesale premiums in China on the Shanghai Gold Exchange, $14 an ounce premiums. So that's near a all-time high record. So if this trend just for a month or so doesn't mean that much. However, if we see these trends continue, say for 2, 3, 4, 5, 6 months, where there's just aggressive dip buying, where central banks are buying enormous net tonnage. We've seen just in the last month or so that a lot of these other emerging market central banks are starting to increase their net purchases of physical gold. This will put a bottom in the gold market because you're not going to see a lot of new supply come online. There's not going to be a lot of new copper mines. There's not going to be a lot of gold and silver as byproduct with those copper mines. And in the oil and natural gas market, well, there is a pretty good amount of natural gas supply that has increased, but the U.S. domestic prices are high, and the U.S. is planning on exporting an enormous amount of liquefied natural gas. So the domestic prices, even if they do crash here in the United States, they're not going to stay low for very long because the U.S. is going to be exporting a lot of that supply. And the producers, I mean, all these costs in the commodities, every business, but especially the commodities business, because it's so energy intensive for mining, oil and natural gas, and agriculture, the costs are just up, Lee. I mean, 15% for Diamondback for their drilling costs year over year. I tried looking at some of these other oil producers. They didn't have the costs laid out as easily, but I'm sure roughly it's around there, some a little bit higher, some a little bit lower. I mean, that's very significant, especially if those costs stay elevated for a number of years.
You know, I think everyone should stay focused on premiums in both precious metals and, crude oil. And I think that'll, when the price declines, but the premiums aren't, I think that's a bit of a red flag. Wouldn't you agree?
Yeah, I mean, if you speak to bullion dealers here in the U.S., a lot of them will say that it's because of the U.S. Mint and how inefficient it is. And then the authorized purchasers. I was actually speaking with a bullion dealer in the last week. He was telling me more about this, how like the U.S. Mint, I think they charge $1.70 extra premium. And then the authorized purchasers for American Silver Eagles, they tack on even more than that. So there's all these extra premiums throughout the middlemen, throughout the supply chain that are added on. So the retail investor.
It's always been that. I mean, there's always been that.
Yeah, but the U.S. Mint, Lee, is run less efficiently than the Department of Motor Vehicles.
Yeah, no doubt about it. But I mean, it was run less efficiently 3-4 years ago when the premiums were much more reasonable. I mean, they're insane now. I mean, it's a couple $100 on gold now.
Well, what silver miner, Lee, can actually make a profit? I mean, there's very little primary silver miners that are doing well. I'll have an article out for patrons probably the next week or two going through the cost of Pan American Silver. I mean, for many, many years, Pan American Silver was the lowest cost or one of the lowest cost silver miners. They were always in the bottom quartile for costs. And Pan American Silver, I mean, for leaving the pleasantries out, Pan American Silver literally on their Q2 for their costs, they shit the bed.
Well, I mean, you look at their stock chart; it's just ugly.
Well, their gold mining costs, Lee, were up enormously. So as bad as their silver mining costs were, their cost to mine gold were up even more.
It's virtually impossible to pull the price of oil and pull the price of gold apart because the price of gold is so dependent on the price of oil, and producing it because energy it's such an energy intensive endeavor to mine.
Well, Lee, diesel is up even more than the oil price. So the diesel. So if you run an open pit mine, your diesel costs are up enormously. Depending upon which country you're in, your electricity costs are up 50% in 2 years. I mean, it's not it's a hard business before energy costs doing it like this, and lower metals prices is an even harder business now. And then you add on how capital for a lot of these, especially junior mining companies and small producers, is either not available at all or it's way above junk bond price costs of capital. Mm-hmm. And this is why I love the royalty and streaming companies, because every bear market for metals prices and mining shares and capital is not available. They just do more deals. And 2, 3, 4, 5 years later, the company has more free cash flow and more growth.
Yep, exactly.
They just come in and clean up.
It seems like a much safer investment than some of these mining companies. So, Well, Jason, is there anything else you'd want to cover on the show?
No, I think that's about it. I mean, there's a lot of really interesting things going on right now in the oil market. So the strong dollar, the oil market, everyone's talking about deflation. But if you listen to the conference calls, Lee, for these companies, they're just dealing with higher costs, the consumers they're telling us how the consumer is getting absolutely killed. Did you hear what the Walmart CEO said?
No, what did he say?
Okay, so the most interesting thing I heard in the last couple of weeks was what the Walmart CEO said. Guess where his largest customer growth is coming from?
Go ahead, tell me.
People with six-figure incomes. So, so people with six-figure incomes.
I have to tell a quick story. I was dating a fairly wealthy woman from Manhattan, and I was away on vacation, and I took her to Walmart, and she just gave me so much grief over that. So it just makes me laugh when I hear that.
Well, keeping up with the Joneses is expensive, but what that tells me, Lee, is if Walmart's fastest growth now is from customers with six-figure incomes, that tells me the consumer, especially the more affluent consumer normally, they're trading down. So they're substituting, they're trading down. They do not have as much discretionary income in their budgets. They are not getting the easy asset price inflation income from trading stocks or stock options, trading stocks on margin debt, trading altcoins on margin debt, flipping homes. This is the stuff that the more affluent were doing for easy profits as long as asset prices kept going up. So this substitution and trading down, you're going to see instead of people shopping at Whole Foods or more high-end grocery stores, you'll see people buy.
They'll be going to ShopRite or their local grocery store instead.
Yeah,
the world is changing. I mean, it's everything's flipping on its head, and the way things have been for the past 40 years is flipping. I mean, we're going back to the 70s type of economy.
Yeah, or they're shopping not just at a regular grocery store, Lee. You also have Target with groceries and Walmart with groceries. So they're going to be shopping at those places instead. Mm-hmm. So those businesses are dealing with higher costs. Their sales volumes may increase, but they're dealing with higher labor costs. Minimum wages are going to go up, and their other costs are going to go up, and they're going to have to clear out inventory for discretionary items. And then after that inventory is cleared and sold at a discount, they're probably going to start raising prices. I know a lot of the deflationistas don't want to hear that.
I think it's inevitable given what's going on in the world. We talked about for the past half hour.
Well, just think about rationally. If you're a business owner and your costs are going up, especially if the government or politicians, regulators, bureaucrats are going to force wages higher, I mean, you're going to probably want to try to pass some of those costs onto your consumers. So if you're going to have higher labor costs, you're going to want to pass some of those additional costs onto your customers.
And you're also going to lay off employees, which is going to put an additional burden on people. So
exactly. So until we're having people screaming about deflation with a strong dollar, demand destruction for commodities futures contracts down, but there's the other side of this are the higher costs in the supply chain problems, and then the supply side problems that are still prevalent. Other than U.S. slightly increasing natural gas prices, Lee, I would argue that actually a lot of these commodities, despite the commodities bull market, there was no new supply that was added online. So we're going to be looking at, again, back to the shorter cycles comment, we could be looking at very violent, very volatile swings that will whipsaw people and retail investors, where in the short term, we go substantially lower, and then 12, 18, 24 months, the commodities prices rally again, and then it's back on again.
Well, we'll be watching it carefully, Jason, and I'm sure we'll be discussing it again as it unfolds.
Well, this was episode number 8 of Finance Unspun. I hope everyone enjoys it. And if you want to look at some of my in-depth research articles on my Patreon, there's over 200 in-depth articles on a lot of commodities companies behind the paywall for only $5 a month.